Okay. All right. Well, good afternoon. I'm Kim Welch. I'm usually presenting, and tonight I feel very fortunate to have a good friend of mine who works for Edward Jones, Susan Mullin, here presenting on just the foundations and fundamentals of investing. And Susan, if you want, you can tell us a little bit about yourself and some of your experiences along the road, because it's been a good journey, I think.
Okay, great. Yeah. Well, my name is Susan Mullin, and I am a financial advisor with Edward Jones. I've been with the firm for 20 years. I started out as a branch office administrator, and then about 4 years ago, they wanted to open up another office and asked me to open up an office on the east side of Richmond. My office is located in front of the Kohl's Shopping Center in the same plaza that Chipotle and Aspen Dental are located in, right next to Starbucks. Everybody knows where Starbucks is, so we're right there. And I became a financial advisor because I just really enjoyed working with individuals, and I have a passion for investing. So that's what led me to switch over to the financial advisor role.
Great. Well, thank you.
Mm-hmm.
So I think if you are ready, we can go ahead and get started.
Sure. So this evening we're going to talk about the foundations of investing, and typically these seminars were created for in-person seminars, and when COVID hit, we wanted to still be able to provide these seminars. Prior to COVID, we did not have any of the capabilities to do webinars and Zooms and stuff, so they've created these so that we can present them over Zoom. However, there are still there's still some issues. So you're not going to be able to see or have the handouts and paperwork. So if there's anything additional that you would like on the subjects that we're talking about, I'd be more than happy to mail those to you, email you additional documents and stuff. And then as I'm going through here, we can stop for questions if you want more clarity on information, on the information that I'm presenting. Okay. Go ahead and get started. So through my experience as a financial advisor, I have worked with many investors who have investing goals and needs like yours, and I'm confident I can help you address these goals. Our seminar today is designed to help you become a more educated investor and to assist you in working toward reaching your unique goals. As unique as your goals are, our process is always the same. The first step is ensuring we understand what's important to you. Only then can you and I work through our established process to build your personalized strategies and the specific actions needed to help achieve your financial goals. We'll continue to partner with you and your family over time, revisiting your goals and your risk tolerance, as well as the strategies we've developed to help keep you on track towards your goals. The path I have mapped out on this slide is only one strategy to help you reach your long-term goals. So when you come in to see me, step one is, where am I today? Depending on what your goal is, we're going to look at if it's retirement planning, we're going to look at where you're at with that, your retirement statements, if you've got a Roth IRA, kind of gather that information. Step two, we're going to talk about what your goals are. What do you want your retirement to look like? Get a picture of that, and then, kind of figure out how much that's going to cost and how much you need to save. So then in step three, I'm going to put together a plan to see if you could reach your goals. And then we're going to discuss that on a regular basis throughout your lifetime and meet and then adjust if we need to. So that's our established process, and that's just using it with like a retirement plan. We can do that with like education planning if you're wanting to save for a child's education or any type of financial goal that you would have. So does anybody have any questions regarding the process?
I don't think so.
Okay. So a great place to start our discussion about the foundations of investing is to answer the question, why do I want to invest? The answer to that question will be unique to each of you, but your answer to that question, why, is the foundation for the investment strategy that is uniquely yours. The answer to why will help you better understand the strategy behind the question, how. Today, we'll discuss 5 basic rules that will help you form a strong foundation for investing. We're going to discuss developing a strategy, sticking with quality, diversify, invest for the long term, and focus on what you can control. There are several tools to consider as you develop your overall strategy. By understanding the foundations of investing, you'll be better equipped to choose those tools wisely. For instance, many of you may be investing through an employer-sponsored plan such as a 401k or a 403b, which is a good way to save for retirement. Many companies match retirement contributions, such as 50% of your contributions up to 6% of your salary. You should take full advantage of that, or at least contribute enough to get that free money, that match. Don't leave free money on the table. However, when it comes to your retirement, you may want to invest beyond your employer-sponsored plan, or you may have other savings goals outside of retirement, such as education or being prepared for emergencies. In this case, you may be wondering how to get started. Most individual investors make their money over time and not overnight. While their strategies may differ based on their personal needs, the successful investors we've known seem to follow the same set of guidelines as our rules for investing. As is often the case in life, the rules are simple but not always easy to follow. We'll review some of these rules now so that you may consider them as you make investment decisions that impact you and your family. So let's discuss developing a strategy. Your investment strategy should be determined by your long-term goals, investing time frame, and your risk tolerance. Some of you may have a goal to help pay for your child's education 10 years from now, and then some of you may be thinking about your retirement. It can be difficult to stay focused on your long-term goals when there's a temporary market decline, or you might find it hard to say no to a new investment that may become temporarily popular. As you make investment decisions, your strategy will help you stay focused on the long term, so it will be easier for you to stay on track to achieve your long-term goals. Understanding your risk tolerance is key to developing your strategy. Your risk tolerance refers to your willingness or comfort level to take risk in the market. So, how comfortable you are with seeing the markets dips and stuff like today, that is what your risk tolerance is. And so how is your risk tolerance determined? Typically, we'll bring you in, discuss that. We'll have a questionnaire, and that helps gauge your risk tolerance. And that's the starting point. By finding the right balance between the risk you're willing to accept and the returns you anticipate receiving, you'll be in a better position to stick with your investment strategy, regardless of what the market is doing. So rule number 2 is stick with quality. And feel free to stop me if you have questions along the way. As I mentioned earlier, if you get tips on today's hot investments, the best advice we can offer is this: just ignore them. At Edward Jones, we're not big on investment fads such as real estate or gold. When it comes to quality, it can be difficult to distinguish one investment from another. For instance, with more than 65,000 stocks available to trade globally, it can be difficult to choose the right ones for your portfolio. At Edward Jones, we will first filter stocks based on geography, longevity, size, and then quality. And then from that group, we further narrow the field by identifying companies we believe have sustainable competitive advantages, experienced management teams, and strong financial positions. Last, we use analysis to determine a fair price for the stock. This process allows us to recommend what we believe are quality companies with attractive stock prices. And at Edward Jones, we have an entire department that, focuses on just stocks and works through all the different companies and stuff that recommend those stocks to us so that we can provide that information to our clients. And then in much the same way, bond quality is as an important consideration when it comes to your investments. When you're buying bonds, don't be tempted by lower quality bonds paying higher rates. Along with these higher rates comes increased risk. The bonds will fail to make their interest payments, so they will default. Stocks and bonds are just two of the more common types of investments. Extending this focus on quality across all of your investments is a good rule to keep in mind. Your financial advisor can be helpful as you weigh your options. In our experience, investment success depends on buying and holding quality investments in a well-diversified portfolio and maintaining a long-term perspective. So the next rule is diversify. Does anybody have any questions before I move on? No single investment performs well under all conditions. If a large portion of your portfolio is concentrated in one type of investment and bad news causes its value to drop unexpectedly, your long-term financial security may be in jeopardy. It's important to remember that diversification won't guarantee you'll make a profit or keep you from losing money. Investing does not involve guarantees, unfortunately. But as I said, diversification can help reduce your risk. There are several layers to diversification, and one is asset allocation, which means dividing your money among different asset classes such as stocks, bonds, and even cash. In fact, allocating your investments effectively is the single best step you can take to improve your investment return potential. There was a major study of the factors that determine financial returns that showed over 90% of the variability of returns is determined by how you allocate your investments. So that's huge. This means that the difference in your returns from year to year is largely related to your asset allocation. As a result, asset allocation has a much bigger impact on your investment success than efforts to time the market by buying or selling stocks when you think they are nearing low or high points. Lots of people try to do that. That's hard to do. Asset allocation is also important. Asset allocation is also more important than the types of investments you choose. To help illustrate the concept of asset allocation, let's look at the investment pyramid that I have up here, which shows the different investment categories. So we've got cash, income, growth, and aggressive. So you start down here at the bottom of the pyramid, you have cash, income, and then the further you go up the pyramid, the more aggressive the investments get. At the lowest level of the pyramid are cash and cash equivalents, such as savings accounts. This is the money you keep for your day-to-day expenses and can also be money set aside for investing. If this money is kept in a savings account, which typically has a lower interest rate, you likely won't earn a lot of money. The next level is made up of investments that pay income, such as certificates of deposits and bonds. These investments generally have lower risk and lower growth potential relative to stocks and can reduce your overall risk of the portfolio when paired with stocks. So it's important to have that in your portfolio. It helps stabilizes your portfolio. The next level is stocks. Stocks fall in the upper portion of the pyramid. The higher you go to the pyramid, the more your risk level increases. However, it also means the potential for greater returns. It's important to make sure that you have the right mix of income and growth to pay current expenses and keep up with inflation. Historically, the average inflation rate has been around 3% per year, and not this year, but at that rate, the cost of goods and services could double every 25 years. So that's why it's so important to get your money invested and to let it grow to keep up with inflation. Does anybody have any questions about the actual investment pyramid?
Well, I have a question. If you are just starting to invest and you're maybe in your 60s, would you still invest in an aggressive stock and diversify?
Yeah,
Or would
you
you go
would.
more?
Well, you could. You definitely want your portfolio to grow, but you might have more of your assets in the income sector and a smaller amount up in the upper tiers of the pyramid. But you still want those funds to grow, and
Mhm.
everybody's situation's a little bit different. If people are in their 60s and let's say they don't they're investing money that they're not intending on using for a while, they could put, a larger portion in, or maybe money that they don't even need to use. If it's like estate planning or something like that, then they may want to just let it grow as much as possible.
Mhm.
So different factors, but yeah, you wouldn't want to, and you wouldn't even have to use like the aggressive sectors. You could scale it back and maybe just do the growth in income. When you're looking at growth in income, you're looking at companies that are well established, like McDonald's and Procter and Gamble, and really good solid companies in that growth and income sector.
Mhm.
So
So I do go into schools and talk about financial stuff, but not ever investing really. But they always want to talk about investing and they have tons of questions about Bitcoin. And I know nothing about Bitcoin. So does that fall in here somewhere? Like
well,
where?
Bitcoin would be at very aggressive. It would be at the very top of the pyramid because, there's just so much unknown about it. It's, not regulated. So we still see it and view it as very speculative. You can't,
Mhm.
we don't sell it or offer it.
Okay.
Yeah. And if people want to buy it, depending on who it is, and what their situation is, but I don't recommend putting, a large portion of your portfolio in something that aggressive.
Yeah.
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 Yeah. But you know what? I get a lot of people asking me about it. And because we're not that involved in it and we don't really recommend it, I don't follow it a great deal
Mhm.
myself. So, but it's funny how the kids are always asking about that.
It is because they hear somebody made a bunch of money, I
And,
guess. And so they want in on that deal too.
can't blame them for that. Okay. Let me Okay. Let me jump back. That slide was missing out of my slide, so I had to stick it in there in a different, from a different group. Okay. Sorry, I'm gonna have to figure out where I'm at here. Okay. Sorry about that. Okay. So the mix of income and growth that's right for you depends on your personal situation. Everybody's is going to be different. Like I said, you'll discuss risk tolerance, and then depending on when you might need the assets, and then also your age. So those all factor into how we would build your portfolio. So let's talk about diversifying a little bit more. When you hear about diversifying your portfolio, that means owning a variety of investment types and not being over concentrated in any investment type based on your risk tolerance and portfolio objectives. I've had some people that think diversifying means putting a little bit of money at each bank and having money at all different locations and stuff, and that's not the case. It's making sure that in fact, that can even harm you because you could have, especially if you have investments, you could have similar investments at different locations and you might be over concentrated in certain areas and stuff, and that could just cause more risk. So let's talk about bonds. Bonds are debt securities similar to an IOU. When you purchase a bond, you lend money to companies, municipalities, states, or the US government to finance a variety of projects and activities. Basically, you, as the investors, lend the money to the issuer, and the issuer agrees to pay the money back at a specific date in the future. Your choices generally range from a one-day short-term investment to a bond that matures in 30 years. In addition, the issuer pays you interest, typically semi-annually, until the bond matures. Most bonds are a $5,000 minimum, investment, then in increments of $1,000 or $5,000 after that. However, this does not mean the bond's purchase price is always going to be par, which is that face value. Did somebody have a question? So it doesn't always mean that when you purchase a bond that you're going to pay that $5 or that face value, like the $5,000, because the price of a bond is affected by the changing level of interest rates, meaning the purchase price can be greater, which is you're purchasing at a premium, or if it's less than the face value, you're purchasing at a discount. In general, the longer the maturity, the higher the interest rate. Longer term bonds tend to fluctuate more than shorter term bonds. So if the maturity of the bond is 30 years, then you'll see the value of that bond fluctuating more than maybe like a 5-year short-term corporate bond fund. There is an inverse relationship between bond prices and interest rates. When interest rates go up, bond prices decline and vice versa. If interest rates decline after you purchase a bond, your bond's market value will likely increase. Conversely, if interest rates rise, your bond's market value will likely decline. However, the rise and the fall in your bond's value are only important if you sell it prior to maturity. This can surprise some investors. No matter how much the price of a bond fluctuates, if you hold it to maturity or until it's called, you should receive the full principal back. So really, you shouldn't get too concerned about the value of the bond, because the purpose of it is to pay you that interest payment, and you're going to receive that regardless, and it's going to be based on that value, the face value of the bond. So as long as you hold it to maturity, you're going to get all your payments plus your principal back when it matures.
And just to get some perspective on bond investing, what kind of returns do they, I'm familiar with money market returns, but not bond.
Yeah, so bonds are affected by the Fed rates, and with the Fed rates being so low and stuff, bonds right now, you're not getting a lot of return on them. And as hopefully as rates go up a little bit, we'll see better returns on those. It just varies, but a balance towards income portfolio would probably pay you, if you had just all bonds, an average annualized return of maybe 3 to 4%. And, you could probably see, some years a 5 or 6%, increase in value, but that's over an annualized return, or over an annualized period of time that, that 3 to 4. And that's just an estimate. I don't have, yeah. But, right now with the way the market is, bonds have been affected by that.
Mm-hmm.
Yeah, and we're not really seeing, those 3 to 4% right now. So I would love to see that right now.
Yeah. Well, thank you for answering that.
Yeah. Many people associate investing with the stock market. So what does investing in the stock market mean to you? You may have heard of the bull and bear markets. The use of the bull and bear to describe markets comes from the way that animals attack their opponents. A bull thrusts its horns up in the air while a bear swipes its paw down. These actions are metaphors for the movement of the market. If the trend is up, it's a bull market. If the trend is down, it's a bear market. When you invest in the stock market, you are buying into a publicly traded company. What are the ways you can earn money investing in stocks? Most people invest in the stock market to earn a return on their investment. 2 ways to do this are through potential growth of principal, also known as capital appreciation, and dividends. So this slide here kind of shows you capital appreciation is the difference between what you pay for a stock and what you receive when you sell it, if it has grown in value. For example, if you purchase a stock for $20, you sold it for $30, your capital appreciation is $10. And then keep in mind that stocks are subject to market risk, which means that stock prices can also go up and down, which could result in a loss of principal invested as well. And then dividends are payments given to shareholders out of a company's earnings, usually quarterly, and can be paid in the form of money or company stock. Remember, dividends are not guaranteed. It can be increased, decreased, or eliminated at any point in time without notice. Traditionally, some quality investments you can make are in dividend-paying stocks. These are usually the stocks of well-run companies with consistently strong earnings, and these companies seek to reward their investors through dividends. Slide 11 here, this slide here shows you that investing in stock paying dividends, dividends versus stocks that are not paying dividends, they outperform them. As you can see, the stocks that historically paid dividends, typically higher quality stocks, outperform stocks that did not pay dividends. Of course, you can also diversify your equities or stocks by sector. Stock market returns of different sectors can fluctuate. If you're diversified, those fluctuations may not affect your portfolios much. So, for instance, the technology sector is a good example. The sector had tremendous growth in the early 80s, but then slumped with a slowdown in the personal computer business in mainframe markets. And then in the early and mid 90s, there were major advances in microprocessor technology that gave the personal computer business a big boost. Investors returned to tech stocks. Then the slowing economy of 2000 and 2001 adversely affected technology, and tech stock prices dropped again. If all of your investments were in tech stocks, you'd have ridden a roller coaster. If you had had some in tech stocks and some in other sectors, your portfolio may have been more stable. Most likely would have been more stable. Do you guys have any questions about that with the different sectors and what that means?
So do you offer like mutual funds so that you're not just investing in stock? Okay.
Absolutely. Yeah. And I'll touch on that here in a little bit. Yeah. And there's mutual funds that, for the different sectors as well. Absolutely.
Okay.
So we've talked about bonds, we've covered the stock market. Next, we'll discuss packaged investments, which includes mutual funds, exchange traded funds, and unit investment trust, and other similar types of investments. Let's start with an understanding of a packaged investment. Packaged investments such as mutual funds, exchange traded funds, and unit investment trust invest in a variety of stocks and bonds or a combination of the two so that you can receive a built-in diversification. When you invest in one of these, your money is pulled with that of other investors. So you're buying shares into a fund. For today's purposes, we'll focus on mutual funds as an example of a packaged investment. A good way to diversify by sector and asset class is to buy quality, professionally managed mutual funds. So what are some of the benefits of mutual funds? Unlike many other investments, mutual funds can be an appropriate investment for larger or smaller sums of money. Diversification. Most funds diversify their holdings by buying a wide variety of investments that correspond to their category. A typical stock fund, for example, might own stocks in 100 or more companies, providing a range of different products and services. So you're very well diversified with over 100 different companies. The advantages of diversification is that losses on some stocks can often be offset by gains on others. You can further diversify your portfolio by investing in multiple mutual funds. So some of them might have more of an aggressive growth objective, and then others might have a growth in income or a dividend paying or income focus on as an objective of that actual fund. So every fund has its own objective. And then again, please note that diversification does not guarantee a profit or protect against a loss. Professional management. Each fund is run by one or more professional managers who are responsible for its day-to-day operations and performance. A typical fund engages a large group of research analysts, traders, and financial analysts, as well as a variety of other investment professionals. This takes the burden of managing the investments off of you. Do you have any questions regarding any of that information on the mutual funds? So what are the ways that you can earn money from investing in a mutual fund? If there are bonds in your mutual fund, they could earn interest. If there are stocks within the fund, they could pay dividends. The mutual fund will subtract its expenses and pass along these earnings onto you as dividends. The second way to earn is for the share price of your mutual fund to increase in value. When a mutual fund's management team tells a security or sells a security within the fund at a profit, a capital gain is realized. Any gains are periodically paid to fund shareholders in a capital gains distribution. You've heard me use the word risk a few times during this seminar. You're probably aware that like most other investments, mutual funds carry their own risk. These risks will vary depending on the type of funds, but some general principles do apply. The stocks and bonds owned by mutual funds can fluctuate in value because of market conditions, causing the value of the fund to fluctuate as well. So mutual funds definitely are less risk than owning individual stocks. You know, if one company, something were to happen to one company, you know, you've got potentially several other 100 companies in that stocks that won't affect, or in that mutual funds that won't affected as much. And then a mutual fund company, you know, again, cannot guarantee results even though you're purchasing a fund. And then if you're looking for a further level of diversification in professional management, there are advisory programs available. And these programs use investments that have been professionally selected and are continually reviewed to make sure they're appropriate for the program. So they're just continuously monitored. And those are typically in a fee-based accounts.
What does that mean? Fee-based account?
Fee-based, it's really just how you're paying for your investments. Like some investments, mutual funds, stocks, you might pay commission or something upfront. In managed accounts, it's there's typically a fee based on the value of your account. You can do a lot more trading and they're more actively managed versus just paying for mutual funds or stocks.
Is it like a monthly fee, quarterly?
Yeah, they're typically, you know, it's a monthly fee that comes out of your account based on the assets within your account. And that's how Edward Jones does it. And I think that most other brokerage firms probably do it very similar.
Mm-hmm.
Okay. So rule 4, it's investing for the long term. Remember, your strategy needs to help provide not only for you, for your and your family's goals today, but also your goals 25 or more years from now. So many things can change from year to year. That's why it's important to talk regularly to make your needs and to make sure that your needs are being met, and if necessary, adjust to help ensure they are. Regular investment reviews are also a good opportunity to make sure that, you know, your beneficiary designations are up to date. You know, that happens a lot, you know, people passing, unfortunately, or people getting divorced, and a lot of the beneficiaries and things aren't up to date in their accounts. So going in and just having those regular reviews are really important, a part of your strategy. So, you know, talking about market volatility, over the past 84 years, the U.S. has experienced war as well as economic and political uncertainty and upheaval. In spite of these setbacks, our nation and our financial markets have persevered. Even during the 30s, which was one of the worst decades for stocks, the stock market basically broke even. In fact, 2009 marked the end of one of the worst decades ever, as stocks fell an annualized 1%, second only to the decade ending in 2008. However, a difficult 10-year period has historically been followed by strong performance, 13.1% on average per year. So that's the good news. Of course, past performance of the market is no guarantee of how it will perform in the future, but that's typically, a lot of times how we look at things and try to determine, what can potentially happen moving forward with the market is what's happened in the past. So it looks like, those strong performance of returns, 13.1%. We could see that. Okay. And so you may need to rebalance or even make some minor changes to take advantage of opportunities, but it's unlikely you need to rework everything in response to market changes. The best asset allocation policy in the world won't matter much if you don't stay invested. A great way to take advantage of time in the market is through systematic investing. Although systematic investing does not guarantee a profit or protect against loss, it does allow investors to buy more shares when the price is low and fewer shares when the price is high. This typically results in a lower average cost per share than if a constant number of shares are purchased at set intervals. It is suitable for investors who wish to invest gradually to help average out the price over time. So these charts kind of illustrate that, and I don't know if you can see those, but in the first chart, somebody has invested a lump sum of $5,000, and so they've paid $20 a share all at once and received 250 shares. In the second chart, you'll see somebody purchased $417 monthly. So they were systematically investing, and on the dates that they were making those purchases, it averaged out to be $17 a share. So they were able to purchase more shares. So by systematically investing, you can hit the market at its lows and highs and potentially be able to purchase more shares. Do you guys have any questions about that and how that works?
I've never seen that chart before, so that's that was interesting.
Yeah.
And I'm assuming that that's pretty common, really, probably for people to just begin. Yeah.
A lot of people do it on a monthly basis, especially like people that want to max out their IRA accounts over a period of, or over every year. Instead of having that money put in as a lump sum, they'll do it on a monthly basis.
Mm-hmm.
So
you did mention the word rebalance. I don't know what that means or how often you should do that, I guess.
Yeah, so it all depends, but a lot of times when you come in for your annual reviews, we recommend maybe rebalancing. In times too, like if the market's taken a dip, or if the market's high, you might want to rebalance and pull some of the equity, some of the profits that you've made, and put those back into some of the income sectors and stuff, kind of protect your gains a little bit. But we recommend coming in on at least once a year and review your accounts and then rebalance if we feel like it's necessary. And sometimes the market just kind of does it for you as well. But if you get too much into one sector or something, we might make some shifts.
Okay.
Okay. So the last rule is focus on what you can control. You can't control the economy, but you can control your saving and spending habits, so you're more protected for that rainy day. While budgeting is not the most attractive word, it can highlight where you're spending and ways to increase your savings, okay? It's also important to establish an emergency fund. We recommend 6 months worth of living expenses. A lot of times, if I have clients that are a little uneasy with just 6 months in emergency cash, I'll say, let's do 12 months, especially with the market, being more volatile and stuff, and they're just more comfortable with that. But that'll help guard against items such as unexpected expenses, job loss. So we definitely recommend having an emergency cash fund. Additionally, you can control your level of debt. Some debt is necessary part of your financial picture, for example, an education, a home, possible, or a home or a car. Those would not be possible for most of us without borrowing. On the other hand, credit card debt can cause financial problems if it's not managed appropriately. And you can't control the stock market, but you can control the way you respond when the stock market drops. If you've invested in quality stocks and allocated your assets, you may not need to take any action. Although we can't predict the future, historically, the market has always rebounded. You may want to use low prices as an opportunity to buy. You can't control tax laws, but you can control the way that you use tax advantages. This can be done by choosing investments with different tax treatments. There are 3 general tax categories, and those are taxable, tax deferred, and tax-free investments. The key differences reside in how and when taxes are paid. Tax diversification may help counter the ever-changing tax environment and help provide flexibility during retirement. You can't control the fact that every investment has some risk, but you can learn about your own risk tolerance, diversify your portfolio holdings, and take a long-term view of your investments rather than overreacting to short-term setbacks. You can control the quality of the investments you own, their diversification, and how long you hold them. Anyone can get carried away by emotion. Just don't make emotional decisions where your money is concerned. So we've reviewed
I'm sorry.
Oh, you are fine. So we've covered a lot in this short amount of time. We've gone over the 5 rules, which are develop a strategy, stick with quality investments, diversify your portfolio, invest for the long term, and focus on what you can control. Thank you. Do you guys have any questions for me?
Well, what are some questions that people ask you when they're looking for someone for a financial advisor? What do you think we should be looking for?
Oh gosh, that I think it's really important to work with somebody that you can connect with. It's somebody you're going to be talking with throughout your life, and so I think that's important. And then I'm trying to think of what questions people usually ask me. They're usually asking specific questions about what they're trying to accomplish.
Yeah.
But,
Well, I just know some people never use a financial advisor, and I don't really know why, but maybe they think that they don't have enough money to use a financial advisor. Is that true?
That can be a misconception. You don't have to have a lot of money to invest. So that definitely, a lot of people think that, and I will say that some advisors do have minimums, but you don't have to have a lot of money to invest, even if you're, older. And, I work with anyone who is serious and wants to, learn and wants to invest. I had a gentleman in here just last week that brought $5,000 in and wanted to work with that and stuff, so we got a plan together for him. So but people can start just systematically investing in mutual funds with a few $100s a month to start out. So, and it's so important to start early if you're planning for retirement stuff. So younger people, those dollars and that compounding is so important to your portfolio and the growth of it.
What if someone's older? You don't have an issue with that either, do you?
Oh, no, absolutely not. So if we've got older investors and maybe just looking for income streams during retirement and want to talk about that, because when someone is older, they still need their money to grow. They still, to live throughout their retirement, especially keep up with inflation and things. So they do need a plan and, have their money growing for them. We just may not be in as aggressive as somebody who's 30 years younger than them.
Good. Well, I just wanted to hear that and affirm that, because I mean, that's what I believe, but I know that for whatever reason, young people don't really connect with an advisor, and then they think they're too old, or they don't think they make enough money to begin investing, and those are all not accurate. So
yeah, I totally agree with you on that. Definitely a misconception. But and I'd be more than willing to send any information to anybody that has further questions, or do one-on-one questions, conversations, Zoom meetings, or appointments with anybody that has any further questions too.
I think Melissa put something in the chat, and I don't know if you can see that, Susan. Her microphone isn't working, but she says that she has a question. She helps her mother with her finances. She's 61 years old and has a 401k through work. The paperwork that they give us only lists source of funds, fixed income, global equity, and money market. What can we do to help her out more? I guess basically maybe trying to understand what those are. And to help me understand more for myself.
Sure. Yeah. Well, if it's in a 401k plan, and unfortunately I can't advise, I can't advise on what to do with those funds, but I can definitely educate you and tell you, give you guidance on, what we would recommend if the portfolio was in an IRA here. Because when you leave an employer, a lot of times those 401k accounts, you shift over to an IRA account with a brokerage firm. And so really you'd have the same type of investments, but you definitely have more options and stuff in an IRA account. But I can guide somebody on how what we would recommend that they put in their portfolio. And then you can take that information, like if your mom is still employed, you can take that information and kind of get an idea of how it should be allocated within the 401k plan. And feel free to, give me a call and I can share some more information with you.
Now, I'm not sure that we shared any contact information. Probably don't have a slide like that, do you?
There
or do you? Okay, great.
Yeah, so again, my office is on the east side of Richmond. I'm licensed in 19 states. I do a lot of investing over the phone, talking with clients and stuff over the phone, through Zoom meetings, webinars. And so I even, drive to some of my clients' homes. So feel free to reach out and we can discuss options as far as if you're interested in a meeting, or to discuss your strategies and stuff further.
Perfect. Okay, well, thank you. Hopefully Melissa got that information, and if anyone wants us to share your email or whatever, you could contact us, but we could give that to Susan, but I think it's just as easy for you to maybe reach out to her in her office staff. So I'm not hearing or seeing any other questions. I think maybe Jason, you want to take over?
Yeah, well, actually, we'll start by thank you, Susan, for your time and the presentation. We really appreciate it. Again, if anybody has any questions, you could reach out to Susan. If you want to go back and rewatch this meeting, we will be posting it to YouTube like we usually do with these events. Probably be up by the end of this week, early next week, if by chance you want to go back and review it. We will, as promised, we always say if you register in advance and sign up, we do a $50 drawing for those that are on. And just to verify, I have Rick, Dottie, Frank, and Melissa on. So unfortunately, you can't see my screen, but I have a wheel that I'm going to spin. See who wins the $50. And Frank Jordan, you won the $50 drawing for being a participant tonight. We will make sure that we get that deposited for you and everything.
That's
And
easy.
again, we want to thank Susan. Thank you, Kim, for helping to reach out to Susan and organizing this. And if you guys have any questions, you can always reach out to us or reach out to Susan. So
Thank you.
Great. Congrats. And thank you, Susan.
Thank you.
Well, I guess you guys are free to go. You have a great night.
Have a nice evening. Thank you.